thanks to all of you for joining us here tonight. Indeed, I have been with the organization now for a while. I believe it's about 8 or 9 years, and it's the 5th or 6th time that I'm organizing this panel here tonight. And I'm very, very excited about that tonight. As you all know, the economy in the US has been going strong here in 2014, and we've been sitting here in other years, 2009, 2010, where I expect that the conversation was a very different one from tonight. So, the S&P has been reaching an all-time high of above 2,000. Check today was 2,075 or something. The GDP grew a healthy 3.5% this year. Unemployment has been declining. It's below 6% now, and about 1 percentage point below what we discussed here last year. Silicon Valley is thriving, as everyone can tell who took 101 up here tonight. VC firms in the US have invested $50 billion into startup companies this year. That's after 2000 and 2001, the third highest amount that was ever invested into startups, and it's a 23% increase from last year. Also, we've had the biggest IPO ever this year in US history with Alibaba, the Chinese company, IPOing at $25 billion. But, well, there is a flip side to everything, and that's why I'm so excited about this discussion here tonight. Fear about inflation is in the market. There are uncertainties about monetary and fiscal policies, in particular in the EU. There are conflicts all around the globe, Ukraine and the Middle East, that have a strong impact on the financial outlook. There are companies or deals in companies are getting so expensive that the one or the other investor has to think about whether it makes sense and whether investing in such a company will make them any money at this point. So there are a lot of stories that are just contrary to what I mentioned in the beginning. So we are here tonight to reflect on the past 12 months and to share our perspective and an outlook for 2015. As Carlin was mentioned, I'm Oliver Harnisch, GABA's co-chair for entrepreneurship and venture capital, and rather me introducing everyone here, I would like to ask our distinguished guests or distinguished panelists to take 5 minutes, introduce yourself to the audience, share a little bit about who you are, what you do, but also maybe provide your highlights of the past 12 months and a pointer towards what to expect from 2015. So Andrea, you sit next to me, you start with an A, so
I was afraid of being too late, so that's why. Yes, my name is Andrea Anderhagen. I'm the founder and CEO of Shopgate. Shopgate is still a German company. Because I moved privately to Silicon Valley, to Mountain View, with my family 6 months ago, to basically become successful in the US. And I use these words because we started 18 months ago here, and we weren't so successful in the first 6 months. And I think there are just lots of differences in how people do business in the US as compared, for instance, to Germany, where we come from. I'm actually half Swiss, half Italian. I'm married to a Brazilian, and I live in the United States. So, it really depends where I am, what language I speak. But as a good Swiss, I speak many languages. So that's kind of the advantage of growing there. Yes, what do we do? Well, maybe previously to Shopgate, I was also the founder of Sofortüberweisung, Sofort.com. Which was been a major online payment method in Germany. And there was a huge and funny fight at the end because we did something crazy. We kind of connected online banks to shops, and we asked for online banking credentials on our website. So, you know, like if you think about which is your most important data of your life, maybe the online banking data is better than Facebook profile, because you know, we can do a lot with that. And yeah, in the beginning, everyone was ignoring us. Then they sued us, you know, the banks. Then they lost, and then we sold it. That's kind of the short story of a 5 years huge struggle that at the end of the day, as I said, was quite successful. And yes, and out of Sofort, we then saw, you know, suddenly we saw that when I got my first iPhone, I suddenly realized, okay, the internet is going to be mobile. And then I said, I'm going to fund a company that sells shoes on a cell phone. And everyone was saying, shoes on a cell phone, that sounds like the dumbest idea I've ever heard, right? And they said, you know, but that was used at Sofort to hear the idea is dumb. So fortunately I didn't trust, you know, I didn't listen to these people. Actually I listened and tried to refine my sales pitch a bit. And that's what I did. So we founded Shopgate in 2009, went live 2011. And what we do is we allow merchants to become mobile. So, you know, merchants today, if you're a retailer, then about 80% of your customers have a smartphone. And if you sell the wrong things at the wrong price, you're not going to sell something, right? And that's the problem. And what you need is an app or a mobile website that kind of gets these customers and sells something in a reasonable way. And that's what we do. So we help merchants become mobile and basically, you know, increase revenues and survive in a more mobile company world. So that's in very short what we do. We've been growing quite well. So we have a total of about 147 employees. Not about, it's exactly 147 employees. And 20 of them are already in the United States. The United States is now growing well since I found all these nasty little differences between doing business in Germany and in the US. It's actually quite fascinating what the differences are. Maybe you can speak about that later, but it's like, you know, it's like really interesting. Yeah, and you don't get it if you just stay in Germany. That's another thing, you know, that comes to my mind on that. And yes, and we're growing well here. I mean, I love the Silicon Valley for the spirit of fearless technology. By fearless, I mean, you know, we have guys here like Elon Musk that tries to go to Mars and makes a colony there. I think it's quite unique to have such a plan. By the way, as a side hobby, he has created a car company, just like, you know, like others play tennis, and he creates a car company. So that's awesome. You know, it's a great environment, and I'm just mentioning the best guy of all here, but there are others also, brilliant people, and so I love it here. Yes, so the question was also what was exciting the last 12 months. Well, it's a bit biased by what I do, but I think the most exciting thing was the development of mobile. So the way that people now search in the internet and use the internet on a mobile phone. I think, you know, it sounds a bit like, you know, okay, so what? You know, they use a smartphone, but it actually changes humanity because it destroys information asymmetry. So you can know everything, everywhere, wherever you are, right? And this transparency, you know, changes all the industries because, you know, suddenly information is not an issue anymore. You know? So when in human history did we have this situation before? And you know, when I founded Shopgate, you know, like, I don't know, almost no one had an iPhone, or, you know, like, but today it's like you just have to observe yourself and look how much time you spend on these devices. And today, you know, selling shoes on a cell phone doesn't sound so dumb anymore because it actually happens millions and millions of times a day. And I think that this is just a fundamental change that will actually change the whole thing also in the future. You know, these information asymmetries will vanish and will have a very fundamental impact on almost every industry. Yeah, so I think I answered both questions, what, last 12 months and what comes in the future, right? So I don't want to speak too much and let my co-speakers work. Thanks.
All right. Yeah, well, it sounds full of that, but I don't sell shoes. Yeah, so Jens Forstmann, I jumped on that rocket a little longer ago. In fact, back in '86, and just yesterday I celebrated my 56th half-year anniversary. And Andy was part of why I'm still here. So I came over and was supposed to be here only for 6 months and go back to Munich and set up a design center. And the moment I landed here, I knew that I would never leave again. And started with a different company, but eventually ended up at Sun and worked with one of the greatest people in the Valley. And built some amazing things. And every time I went back to Germany in those years, I was explaining what I was doing and was so thrilled about it, having one of the best jobs in the world. Everybody just looked at me and said, that doesn't sound like a lot of free time. Sounds like you're working on weekends. And, yes, we did. But as Axel on the way up and I, we were carpooling, reducing our carbon footprint. We're talking, we were both pilots. Companies like Sun also allowed us to go flying every Wednesday to go skiing in winter. So we would fly up, and the very early cell phones were available. In some ski areas, especially the one towards LA, had already cell coverage. And I remember my friend calling from the lift, yeah, I'm between meetings. What can I do for you? And, so Sun gave us a lot of freedom, and I think it was a fantastic experience. And for somebody who just came off the boat, it would really change my life. So I stayed here and eventually got the startup bug and did a few of those myself. Saw a lot of very interesting technologies, but all these years it was always focused on building something and not actually seeing how the market would adopt it. It was always building technology and relying on some organization, or as one of my investors called it, several oceans to boil later, cell carriers. We were doing location-based services in the 90s, and we were about 15 years too early. So not so good for my investors, but we had a lot of fun. And eventually managed to sell these companies and did good. But what it brought, sort of the thing that brought it all for me together was my last company called Redbox. You may have used my product, a DVD renting kiosk. And I refused in the beginning to even get involved in it. There was two founders from Los Angeles with 2 kiosks, 2 Redboxes. And then got involved because I loved how this product used all the technology I built before. It was computers, it was what we now call big data and cloud. We didn't call it that. It was mobile technology to make reservations. It was connected devices. It was a lot of mechanical and hardware things I had some experience with. So I brought it all together, and I realized that it's not just the web. It's not just building a computer. It's about systems. So then came an interesting time while I was busy doing that. And the reason I'm talking about it is because I think this year and next year are going to be fascinating in terms of startups being able to change our daily life, which is the Internet of Things. So I'll talk tonight a little bit about that and why we think, especially the industrial Internet of Things, can really change things. What we have seen this year is essentially how that marketing buzz has really shook up a lot of companies, not just the big guys, but a lot of sort of mid-tier companies, Germany, the Mittelstand, where suddenly the Internet of Things can really change how they do business, how they do logistics, how they do manufacturing, how they do all these things. So we think there's a massive opportunity, and we are kind of seeing ourselves as the guys in the middle between the startup crunch, where suddenly it's no longer just about building web technology, but suddenly building these systems. And while they don't have to build a red box to the scale of red box, but it's about connecting hardware, software, analytics. It all comes together, right? Dealing with security, sometimes privacy issues. We are dealing with the what I call the corporate crunch, where a lot of these corporations just have lost the ability to innovate. And they're looking at companies for them to be acquired, but acquisitions aren't really oftentimes the answer. So we actually think that earlier acquisitions that don't look like full-blown companies are sometimes the answer. And that brings us to the last angle. So there's this thing called the Series A crunch. Series A used to be when investors would invest $1 million or $2 million into a startup. Nowadays, real VCs don't get involved until you have several million in revenue, and maybe they invest several $1 million, right? But the sort of seed stage we are focused on is fascinating, where essentially companies go from a single customer to a regular business model. And that's a stage where you need to define and decide whether a company or a startup is becoming a company and should follow that path, or it was just a project and it should really be acquired for its intellectual property and maybe the team. So we are at that point, and it's a fascinating point, working with several corporate partners to see if, again, the company should not be shut down, like many VCs look at these companies that failed, but rather be placed in some situation where it can reach its potential. So we do that, and at the center, essentially invest our own dollars. You got to put your money where your mouth is. So we're having a lot of fun. We think 2015 will be a great year because, again, all these startups are suddenly seeing traction. The corporate world is listening with the big balance sheets, and IoT is essentially the big disruptive force that's waking up everyone.
My name is Axel Merck, and I'm a little bit on the outsider here in some ways. I'll tell you in a second why. But my pedigree is actually not all that different, I think, from most on the panel here. I have a master's in computer science, and I dropped out of a PhD program to start my business in the early 90s. Except that the type of business I started wasn't your typical .com business. I started an investment advisory shop. And it's always, and still is in some ways, a mom and pop shop. But I took it to the US in 2001. And then it was in 2003 or 2004, I spoke at a GABA event, I recall. And that day I kind of framed of where the path that we've been on ever since. At the time, the head of the European Central Bank, Van Duisenberg, he said, "We hope and pray the global adjustment process will be slow and gradual." And my reaction to that was, well, when policymakers start to pray us when they conduct policy, I got to do something about it. And that really set the tone for everything we've done ever since. And so in 2005, we went into the mutual fund business to try to address some of the challenges that we saw at the time would become about. And so in many ways, we've always considered ourselves entrepreneurs, except that we're dealing in the big financial services industry. We have 4 mutual funds these days, we have an exchange-traded fund these days that try to cater to some of these things. And so, which brings me to my outlook. I'll spend a little bit more time on my outlook and come more from a kind of a macro, from a policy point of view. Yes, we've had a recovery in the US. In some ways, we've had the best recovery money can buy. And I put on your chair this little leaflet here. And what these lines show is, those are comparisons of the printing presses around the world. How much money has been printed. And I'm not going to quiz you on that and go too much into depth on that. You may want to take it home and study more detail. Maybe later in the discussion we can talk about it a little bit more. The one thing I do want to pay your attention towards is, towards the bottom is the European Central Bank. It's a line that goes up and then comes back down. It's one of the reasons why Mario Draghi is so frustrated. But without going into too much detail there, one of the big themes in the US and globally is this disparity in the recovery, that those with assets have done very well, but those without assets have not done well. And that's a direct result, in my view, of the monetary policies we have around the world. When money is free, it means if you know how to deal with credit, you do great. If you're a hedge fund, you do great. If you're a venture capitalist, you do great. If you're intelligent, you do great. But if you don't know how to deal with credit, you get hooked on credit, you fall into debt, you fall through the cracks with a lot of debt, you have a big problem. And so it's monetary policy much more than many other things that create this wealth gap that we have and creates many challenges in the world. The other big challenge we have in the world is, of course, we haven't solved any problems in recent years. And we have, as many people have said, we've kicked the can down the road. And one of the things that has happened over the last 14 years or so is that we have tried to, after September 11, we have tried to kind of kick this economy into overdrive. And what happened is global policies promoted growth, which led to high commodity prices, and ultimately it also leads to low consumer goods prices. And consumers get cheap goods, but corporations have been squeezed, and that accelerated the outsourcing trend. Well, what happens then as a result is that the typical middle-class American doesn't see any wage growth. Well, when you don't see wage growth for over a decade, you kind of become dissatisfied. And you vote for more populist politicians. So you have the rise of the Tea Party, you have the rise of the Occupy Wall Street movement. Ultimately, of course, as far as the government is concerned, we have increased our debt load dramatically. And so we're particularly good at kicking the can down the road. And the same issues we have in the rest of the world, they just manifest themselves differently. In the Middle East, we start revolutions because people can't feed themselves anymore. In Japan, we elect a populist prime minister to try to solve these issues. In Germany, we fiddled a little bit with austerity. Ukraine can't balance its books. That's the major challenge Ukraine has. And they were begging to get discounts from from Russia, and now they're trying to get discounts from the EU. So we all have the same sort of challenges. They manifest themselves a little differently. Currently, if we the current biggest challenge for Germany or for Europe in general is not cheap money. Money is cheap, well enough, but it is the challenges with the sanctions with Russia. I'm not saying they're good or bad, but they dampen consumer sentiment. Printing money, cheap money, cannot fix that. And so those are some of the challenges that we have. In the US, we're particularly good in dealing with some of these issues, but that doesn't mean we have solved any of these issues. And so as I look out for next year, I just mentioned, one of the big achievements of this year is that we've had this recovery that money can buy. Well, without getting too technical, the one thing that happens when central banks are extremely active in these markets is that they make risky assets appear less risky. So junk bonds don't yield anything anymore. Venture capital investments seem safe. The stock market seems safe. Well, and in that process, all asset prices are rising and we all feel good. The problem is that if for whatever reason, fear is coming back to the market, volatility is coming back to the market, as happened earlier this morning. I don't know how many of you know that the Greek stock market today fell by 13%. The Chinese market overnight, last night to this morning, fell by 5%. We don't see that here because these things are tapered over, but we see this undercurrent that maybe not everything is right. Maybe if we have this great recovery, why are interest rates still at zero? And the challenge is if we go back from the zero interest rate environment, volatility has to come back to the market in our view, and that can create a lot of turbulence. And whenever we've had this exit talk, we've seen some of that happening. And so we're going to be up for some interesting times. And the good news is that Silicon Valley in some ways is shielded because the folks who have the intellectual know-how to be innovative, those guys will be fine. But on a bigger global scale, because we haven't solved the problems we have, the one thing policymakers throughout the world have in common is that they never blame themselves for the problems. They blame the wealthy, they blame minorities, they blame foreigners. And so with that, political instability throughout the globe is on the rise, and it's in everybody's interest to try to tackle many of these problems, except of course, when money is cheap or free, we don't have any incentive to solve these problems. And so that's why I sometimes say I like to give these talks on the ground floor so nobody jumps out of the window and hurts themselves. But anyway, that's a little different perspective from what you have from the other panelists, but I hope I can kind of add some perspective to the venture things as well.
Hello everyone, my name is Dan Levinson. It's kind of funny for me that you said that you're the outsider, because I'm definitely the outsider here. I'm the only non-German speaker off the panel. And before I share what I do and everything, I was thinking, Oliver, when you invited me here, and I was driving here tonight, the topic of the evening was, you know, our forecast of what's going to happen next year. And remind me of the story, I don't know if you know it, about Albert Einstein. I figured it's a good starting point for our relationship. I'm Israeli, you're German, Albert Einstein is a good starting point. So Albert Einstein, you know, dies and goes to heaven. And he meets the first person, and he has 180 IQ. And he's like, oh, fantastic, we can sit later and we can talk about physics. And then he meets another person, and he has 120 IQ. And he goes, oh, wonderful, we can find some time and we can talk about literature. And then he meets a third person, he has an 80 IQ. He's like, oh, shakes his hand, smiles to him. What did the market do? What's the market going to do? So, as I said, I'm from Israel. I moved here 2.5 years ago. Until a few months ago, I was managing the only Israeli bank that operates in Silicon Valley, focusing on technology companies. Beforehand, I was in Israel, also financing technology companies in Israel, of course, both as a banker and as an equity investor in a private equity fund and a VC fund. And nowadays, I work for an American bank called Comerica, where we also finance technology companies, not only Israelis, but of any color. So I've been around technology companies forever. I come from the startup nation, so I'll try to give the Israeli view of things. But in many ways, Israel is like Silicon Valley, very tech-centered, and here we live in a bubble. Whether you think the economical conditions altogether are a bubble or the market is a bubble altogether, definitely Silicon Valley is, like, you know, as you said, protected from the rest of the environment because of the tremendous growth of the major companies around us. And still, you know, we see valuations going crazy high. We see burn rates are, I'm talking about, you know, startups. Startups nowadays have the highest burn rate, meaning how much money they burn each month or each year, highest ever. And it's a concern, especially for bankers like me that finance these companies. And also, you know, you mentioned A crunch, and the round A crunch. Where does it come from? But also, when I spoke to Oliver, but you know, I said, you know, let's start to think not only what will happen, also what, you know, what was and what will be. And I think the most significant change in the VC world in the last year or two is the tremendous growth in seed funds and seed investors and angel investments and angel groups and crowdfunding platforms. And all these vehicles that invest in very early stage, seed stage companies, not a lot of money, but enough to get them a good runway until they reach the A round, which is the VC term. On the contrary, there is a diminishing number of active VC funds in the US since 2000 until today, continuously going down. There's just not enough money, even if the companies are doing okay, there's just not enough money and sources to fund those in the A stage. So it's a concern. It's a concern for the economy, and it's a concern for people like me who fund these types of companies. And it's a challenge that we're going to see how the economy faces. So that's my spiel for this beginning, and we'll see how the conversation goes.
Okay. My name is Andy Bechtelsheim. I've lived here now, what would you say, since 1975, which kind of dates me. I came here as a student, studied computer science, started a number of companies, including some microsystems in 1982. Now my fifth startup, or and a serial entrepreneur, I guess, by nature. In the meanwhile, I also invested in a lot of privately held companies, including Google and others. And it has been a very interesting time period, for the last 40 or 50 years here. And in many ways, I feel very lucky to have been here during this time period. Because of the birth of the microprocessor, the whole, evolution of Silicon Valley, the magic of Moore's law, which makes everything better every year. I mean, you couldn't have, at the rise of the internet, the web, you couldn't have asked for a better scenario. And now, of course, we have the cell phones and the smartphones that keep us connected wherever we go. In many ways, I have to share with you my feeling that I'm not sure it can get much better than this. In other words, we have sort of done what Star Trek people envisioned 4 years ago, the universal communicator. We have it, everybody has one, we can do whatever we want, anywhere, anytime. And it's actually hard to see what the next major innovation, I mean, there will be gradual innovation, the screen gets bigger, the connection speed gets faster, the apps get better. But the fact that we're all interconnected the way we are today is sort of unheard of. If you think about it, that the first smartphone really came out in 2007, and before that we had much more limited sort of connectivity. Since I was supposed to talk about the economical issues here, so I got myself some notes here, and I apologize. I'm suffering from early Alzheimer. Okay, so the first point I was going to make is the last 6 years, ever since the great recession, or it wasn't quite a depression in 2008, have been unarguably the most unusual period of time in the modern finance history since the last depression. And obviously what happened was there was this very sudden meltdown in all kinds of financial instruments, including all kinds of junk bonds and housing bonds and collateral obligations that should have never been created. But suddenly it seemed like, at least for a short period, that the world, the financial world as we know it, may actually be melting down. So I'm not sure you remember this, but back in 2008, which is when the last sort of Bush administration was ending and Obama was about to take over, people were literally wondering, what's going to happen, the next week or the next month. And obviously the central banks of the world, came to the rescue. We have had this unparalleled history of low interest rates, quantitative easings, 1, 2, 3, around the world. Some countries being more flexible than others, perhaps. But bottom line, there was a miraculous recovery engineered that, if this hadn't happened, we maybe not be here, or we may have had a completely different outcome. And certainly the US economy recovered nicely. We're finally back to the same levels of employment in terms of people working as they were in 2008 or 2007, excuse me. On the other hand, as has been discussed before, the jobs that were created, the average income hasn't really gone up, and arguably the labor position rate is lower than ever, meaning fewer people actually working, even though the unemployment rate is down. And the net of all this is that the overall spending power of the consumer hasn't actually gone up that much. So the people who did really well are the people who had investments in the financial assets. The stock market's tripled in value of the indexes in the last 6 years, and we may never see this again. So it's not, on any relative basis, the market was arguably oversold in 2008, 2009, and it may be at the higher end of valuation, historical valuation ranges as where it's now. But again, the average person that did not have money in stocks or in their 401k hasn't seen any of this. Maybe their house values, recovered. So in Silicon Valley, the housing market is back to where it was before the recession, but that's not true in a lot of parts of the country. So the outcome of these 6 years is sort of decidedly mixed, depending where you were and what happened to you personally. Silicon Valley clearly has done, I would say, the best of any region in the US, and one almost feels like one is isolated, from the rest of the world. And when nobody really cares what's going on in Greece, if the market goes down to what was it, 30%, people don't even notice it here today, right? Whereas if you're in Europe and have your money in Greek bonds, you for sure notice that. So, but going back to the more recent sort of history now, so here we are in 2014. I would say the single most surprising thing this year was actually the fall in energy prices, meaning oil. And I certainly didn't expect this. It's sort of one of these supply-demand things, pump more oil and demand doesn't go up, the price will fall. And it's a double sword kind of thing, which is, it's arguably good for consumers, which are spending less money to pump, and some people argue that the economy will grow faster because of this. Has been really bad for energy companies and people in energy exploration. Those market indexes are down like 25% for the year. So nevertheless, what's surprising is despite the decline in energy values, which is like what 10–20% of the economy, the stock markets themselves are still at near record highs, and it was in a few percent of the all-time highs. And again, overnight, China was down 5%, which was down, what was it, 13%? The US market is actually ended unchanged for a day. Like nobody cares, what's going on in the rest of the world. So the resiliency in the US market, which I believe has to do with the fundamental optimism of the US consumer or average citizen here, which is arguably higher than in Germany or Europe or anywhere else I know. And this is some deep thing in the deep psyche of the American mind. Like, whatever happens, we will survive. Certainly California, there's all the crisis here over the last while. Like, it wasn't raining for the last 2 years, but it's raining now. It's going to rain this week. Problem solved. So it may be this sort of from sheer spirit that is still existing today, that people believe that the future will happen here, and no matter what happens anywhere else in the world, the Americans will do well. And arguably, if you are an investor, the American market was the place to be, not just for this year, but for the last couple of years. It has done better than any other major market worldwide, needless to say. So, so that's sort of the current situation. Now, forecast, which is very dangerous. So I have actually read some reports published literally today. What do people think about what's going to happen next year? And so these are not necessarily my numbers, but famous people like Goldman Sachs, which is famous for having some of the smartest people in the world. So they published this report today that they now think that the year-end target for the S&P 500 for next year, end of 2015, is 2100. Now today it was at 2060. So they're saying, in other words, it's going to go up 2% next year, which should be the slowest rise of the last 5 years. And Goldman has been pretty accurate in their previous forecasts, I should note here. So one has to be actually crazy to put a lot of money in the stock market with all the sort of volatility that you get during the year to hope to get a 2% return. So this is not for the for people that actually believe that. I think most of the investors that believe the returns will be higher. But I would say, and this is my own view, is that we're closer to the top of these valuations than any kind of bottom. You're not going to see even doubling in values anytime soon. And more likely there will be some immense volatility as certain, and there's one forecast that is easy to make, which is interest rates will go up. They may not go up in 6 months, maybe it's 9 months, maybe it's 12 months from now, but interest rates will go up. In an environment where interest rates go up, stocks generally don't do as well because there's an alternative way where people put money. At the same time, you don't want to hold long-term bonds, because when interest goes up, those bonds go down, they trade inverse in value. And commodities have been doing well because demand in China is collapsing, and gold, which until recently was down like 40% since 2011, they ticked up a few percent today, but it has been basically bad news for gold bugs. Silver was down almost 70% since 2011. So there has been no single market that has done really, really great except the US equity market, which is just an unusual situation because, again, the overall economy wasn't that stellar, right? I mean, it was sort of a Goldilocks scenario where it was growing just slow enough that interest rates were not going to be raised anytime soon, and not too fast that that was going to happen, or not too slow that it's going to collapse again, but not too fast that interest rates come sooner than expected. So the sum of all of this is that it's an unusual time in history, in financial markets, and it may never happen the same way again, of course. But we had an incredible 5-6 years in terms of the US market, certainly. And this was, by the way, not true for many other international markets. In particular, the Chinese market, which was at 7,000 the Shanghai 5 years ago, is now at 2,700. It hasn't gone up in 5 years. Okay, so if you had your stocks parked in China, that was the wrong market to bet on, even though the Chinese economy overall grew 7 or 8 or 9% year by year for the last couple of years, which is sort of the envy, for the rest of the world. But arguably, they made a lot of infrastructure investments, including housing things, which is really a bubble where they built things that they now can't sell. And this was financed by some shadow banking system, which nobody seems to understand. So the real question in China is that they actually may have a crash, sooner or later, which wouldn't be good for the rest of the world either. But that's why the Chinese market is appealing value to where it is. So yeah, I wouldn't put any money there. And Europe, of course, is in its own kind of slowing. The southern part of Europe, as you probably well know, is doing particularly poorly with youth unemployment at about 25 to 50%, depending on the country. Germany has done well until recently, but it's also slowing down to what is now 1–1.5% growth for next year. And some of the Nordic countries did the best. They had some oil, but that's getting cheaper now too. So it's hard, in my mind, it's hard to get excited about Europe as an investment target. But arguably one should invest when things look bad. Except the European markets are still again near record levels. which kind of makes you wonder what people believe about the future there. Bottom line is, it would be hard to be an investment advisor and look clients, straight into the face saying, I know for sure, this is the right place where you should place your chips for the next couple of years, and it was arguably much easier, for the last couple of years. I'll leave it at that.
Well, thank you to all of you. That was a good start, I would say. Things to digest. We've heard different things. I mean, I've heard crunch several times, the corporate crunch, Series A crunch. I've heard bubble several times. But then I also heard VCs will do well, and it feels like a safe investment, actually what you said. So my question is, everyone knows the 80-20 rule, like 80% of the effect is caused by 20% of the cost. So in a VC world, 80% of the profits are made by 20, and it's 20, not 20%, but 20 of the 800 VC firms, which is 2%. So the question is the new rule like the 82 rule for the VCs? Anyone a statement about that?
Well, it's actually worse than that. So the real problem is that there's only so many few ideas that really pan out in a really big way at the end of the day, right? And it may be 10 companies a year that are truly spectacularly successful. There may be many others that do a decent business, but I'm talking about the ones that really generate the high returns for the venture investors, right? And this is now out of 4,000 companies that get funded each year, right? So you have this base level of 4,000 companies that get seed funding from all kinds of sources, and then there's like these 10 companies that emerge that are like the big winners. There may be another 100 that are, get sold or do okay as well. But the probability to get from the 1,000 floor level to this 10% level is not even 1%. It's microscopic slow. And what happened on the VC side is that the most famous brands of venture capitalists that have the most money, they build up these most likely deals to insane valuations. This is sort of this new billion-dollar club where, as of this year, or as of today, I believe there's 48 companies, privately held companies, that are valued at greater than $1 billion. And this is even the height of the dot-com bubble. There was only 10 such companies. So the inflation of private valuation has reached amazing heights. In fact, at the beginning of the year, it was only 27. It's doubled during this calendar year. Why? Because these people are perceived, things like Uber and Airbnb, like all of these in this club, right? They're perceived to be the next big winner, and people just want to pile in at any cost to have a winner on their balance sheet for their limited partners. But the problem with that is, among the companies that actually did go public this year, there's at least 30 high-tech companies that are now trading way below the valuations that were put on them by the private investors before they went public, between 25 to 50% discounts. So if you don't get into the latest Uber deal, don't worry, because you will be able to buy those shares guaranteed at a lower price. It makes no economic sense what's going on here, except I would call it window dressing, venture capital style, where they want to be famous because they were an investor in Uber, right? Because that you need it on your resume so that you get better deal flow for the next investments. Mark Andreessen, who is sort of famous for this, he said publicly the only thing that matters to him is to be in the top 5 most likely successful companies this year, and he will pay whatever price it takes to be in those deals. So that kind of strategy has driven up these valuations to insane levels where one wonders, what kind of return can you actually make. And some of them have done well. Okay, I'm not saying that it doesn't work across the board, but for the very late stage investors, I would say the returns are questionable.
And if I can just add to that, I think that's one component, probably the most important one. The other one is, I think, that companies, especially venture companies, they're ever more feeling urge to come to market as quickly as possible. And that's one of the reasons why the burn rate is so high. It doesn't matter how much the office space costs. It doesn't matter how much the employees cost, as long as we get to market tomorrow. Former Fed Chairman Greenspan, one of the things he's touting these days is that if you were to measure GDP a little bit differently, rather than saying every dollar you spend is worth the same amount, but you actually weigh the dollar spent according to the expected life cycle of that dollar, then you get some very interesting results these days. So if you invest something in real estate or in oil exploration, it has a very long value, whereas a massage or a haircut is a very short-term value. So we're the shortest point in history as far as a time-weighted GDP is concerned. So people are investing not so much for long-term projects, and he includes software projects in that as well, because the return on software is trying to be very fast. And I don't know how much of that is the kind of what exactly drives that. Many people attributed that to the uncertainty in the long-term regulatory environment, but on the VC side, it's just that there appears to be this urge. You want to be in the market tomorrow. It doesn't matter what the cost is. Now, as a quote-unquote real business on the other end of the spectrum, we don't have venture capital in our firm, but we compete with the office lease space, we compete for employees, where everybody else doesn't mind how much they pay, and it puts up certain strains on the business. Silicon Valley has always had some of that, but I think we are at a time where some of these issues are more acute than they have been in the past.
Yeah, I mean, my perspective is, and again, I don't consider myself really as a venture capitalist. I'm just, you know, an organized angel investor. But it's fascinating to see this, because I was sort of in that machinery in the late 90s and early 2000s, where I remember we had raised a fortune, like $40 million, to build a mobile messaging platform, and I'm sure that can be done for like $300,000. But our VCs were giving us all that money, and I remember one board meeting where I was still the CEO, criticized for not spending more money on dressing up our building. So we spent an entire $1 million just to dress it up in an architectural award in Architecture Digest in 2001. And that was how my performance was measured, right? So I think we are coming back to some of that, right? But yeah, I do agree, and I think it's, in fact, the pressure I'm getting these days is from my limited partners, my investors, in our small fund. They are telling me exactly this. Why don't you invest more? Why are you not more aggressive? And we're saying, look, these valuations, I mean, even in our space, the seed space, we're saying, that these valuations are ridiculous. We are reaching outside of Silicon Valley to find sort of more humble innovators. And in fact, they brought me to Oliver, and we are looking at some German companies, because this effect is just crazy, right? And I just don't want to jump into that.
I wanted to add something, which is, you don't have to be the most successful company to have a great startup. So, as a specific example, let's say you have a small startup doing some app for the iPhone, and you've got 10 people working on this, right? And then you find that somebody wants to buy your company for, say, $10 million. And you did it sort of on a shoestring budget, so the average return per person would be like $1 million. It's actually a great return. That's actually the same return you would get if you needed 100 people to build a $100 million company, or more likely you need more than 100 people to build $100 million, you actually get less per person. So there's actually a separate opportunity for small startups that are working at home or out of the library or whatever, and save as much money as they can to do things on a shoestring budget and still develop an interesting product, because more likely than not there is somebody else who will want to buy that product to aggregate it into some bigger thing. So there's there's opportunities at each level, right? And in particular, these sort of whole app economy, there's very few apps that ever create large revenue, but there's thousands of apps that are create maybe $1 million a year for people, and those can get quite interesting if people do a great application. So again, there's startups of all sizes, right? And it's true in Germany as well.
And you can create many things on a shoestring budget, or at least in today's world, and I disagree with you a little bit that the future isn't quite as bright, because it is so much easier to start a business in some ways. Yes, sure, it's expensive to get office space, but the one thing that's easier is you can get all the components. You can outsource everything these days. So the only thing you need is you need to manage the outsourcing partners, and obviously if you deal with some big institutions in our business, for example, we have come to market with a product that's incredibly complex in some ways, and you have to deal with about 5 large financial institutions. Well, as long as you've got the reputation, you can do it. You just plug them together, you manage them, and then off it goes. And so for some of them, yes, you need financing, but it is in some ways much easier to innovate, because you get all these building blocks in place, and you just have to put them together and then drive the business from it.
And you need very little capital investment. You can do all this stuff in the cloud, which means you don't have to buy in computers except for a laptop. By the way, I didn't mean to say my outlook is sort of that negative. But the risk, let me paint you not the worst case scenario, but sort of what tends to happen on down cycles, which is, let's just say a company raises a bunch of money, they have a high burn rate, they're spending like crazy, but then the stock market tanks by 20-30%, and suddenly the venture willingness to invest aggressively goes down, and they're building up, please go down, except you have this high burn rate, and at which point, if you can't raise more money, you're actually dead in the water. And the problem is, as a startup company that is not profitable, you have to have essentially funding, either committed or have access to potential funding that gets you to profitability in the future. If it isn't for that, you're basically just a walking dead, right? And this is what happened back in 2000, 2001, where boatloads of companies had high burn rates and not very promising, say, business models that just disappeared overnight because nobody was going to give them $1 more. So that could happen again. The best ideas generally all survive, but the less good ideas, get weeded out pretty quickly. In that scenario.
Can I just add one thing on a pessimistic note? Just a note of disagreeing with you. Now, you indicated earlier about the US markets being the best performing ones and somehow that reflecting on a good US economy. I see it very differently, especially over the last half year. US markets have been going higher and higher just at the same time as the US dollar has been rising quite rapidly. And to us, or to me, that indicates very clearly that the folks who have been buying are the foreigners. It's because the rest of the world is so miserable. They look around, they see that in the US everything is doing so well, and so the rest of the world has been buying the US markets, bidding them up. Now in many ways to us this is like retail investors used to be. Retail investors aren't in the markets anymore because they have no money. But the foreigners are in no retail, just as Germans bought all these asset-backed securities in 2006 and 2007 and got burned. Foreigners are now buying the US market because everything looks so great here. And this morning, when the market was down sharply before it recovered, the dollar then fell because it was the foreigners pulling the money out again as they deliver. And so we, similarly, in late 2000 or so, we have everything looks great as asset prices go higher, but this thing the glass can be half empty very, very quickly. And especially when latecomers to the game bid up asset prices.
I don't disagree with this whole I would like to observe that the foreigners who did buy the market this year had a double benefit, which is not just the market went up, but the US dollar holdings went up as well. So that the euro declined compared to US dollars by what 10% in the last 6 months. So somebody who went from Europe to US had a 10% currency gain and another roughly 10% market gain. So there was a truly good move for those players. Of course, this may not repeat again, but for those 6 months it was a great scenario. You had something?
Yeah, I kind of would try to not agree with you guys about the pessimistic view. I'm sorry, yeah, I'm James Byrne, and I'm a bit younger as well, so maybe I'm over-optimistic. I'm sorry. People tend to, and here as well it was mentioned, tend to compare the situation today with what happened in 2000, 2001. And then say, it's like a bubble similar to then. It's not. Well, you didn't say that, but you say there's a risk. Be closer. But now let's have a closer look to what's the difference between 2000 and today. So in 2000 we had 300 million internet users. 300 million. That's that's about 5% of the population. Today we have 3 billion. 3 billion. That's 10 times more. That's one thing. The second thing is, in 2000, how did you use the internet? You had a local PC that you had, we were laughing about the modems, these funny sounds, and you got into internet, you waited maybe 3 minutes to get the website open. So, it was probably better than that, but you get what I say. And today, you connect the entire day with the internet. Again, mobile, or Internet of Things, whatever, connects to the internet. People are much more online than in 2000. So it's not only about 10 times more people using it, but it's also, I don't know the numbers, but I would guess 4 or 5 times more usage. So effectively, if you look from an internet company point of view, the market is 50 times bigger than it was in, but the stock prices are not 50 times higher.
But the reason stock prices aren't 50 times higher is because people are not making any money. If you look at, I'm not questioning that there are places in the market where you can make a fortune, but if you look like a company like Amazon has never made any money. And one of the things that the internet is creating, and we are, one of the things when the internet kind of grew bigger, it said, oh, this levels the playing field, everybody has an opportunity, and in some ways, of course, that's right. But what we see is, we see these monopolies emerge. Be that a search engine, be that, if you go online sales, you go to Amazon. And there's tremendous pricing power you have then at that particular level. And of course, that creates different opportunities. I'm not saying one should be discouraged from the markets, but a lot of the folks have not been able to monetize what the sort of things they're going into, and the market reflects itself.
Yeah, I'm sorry if I'm so how to say, frech in English, but I think that Amazon is a completely wrong example, because what they do, they don't do money because they invest everything in other businesses, like, you know, AWS or other businesses that are not related directly to the e-commerce part, but they just invest the whole thing again. So that's why they don't do earnings, but it's still very valuable, because, you know, they are building a market position that is really hard to get for any competitors. So that's one thing. And the other thing is, you know, you guys mentioned startups like Uber and Airbnb and so forth. Yes, it sounds a bit crazy to have a $40 billion valuation for a car network king software in one hand. But if you think further, you know, Uber is one of those examples where technology changes entire industries. You know, and if you look, I mean, I've been thinking about why is that valuation so high. I would say, I think that Andy is certainly right that some VCs just want to be there to have Uber as a logo on their website. I would say that's probably very, very true. On the other hand, you could also speculate that Uber would have a very significant impact on the entire transportation industry. You know, and I'm not talking only about taxis. I'm talking about, you know, the fact that our cars are only used 5% of the time we have them. So we have a car and we use it only 5% of the time. Why? You know, so it can have an impact on the car industry. The logistics, you know, DHL, UPS. Why do I have to pay so much if there is a guy who can bring it to the other? You know, so kind of the whole transportation industry is at stake with this networking of the software. That I think is fascinating, and the same goes for Airbnb, same goes for what we do actually in commerce. There is so much connectivity, and the reason why many startups don't do money now is because they invest in growth to then turn on the money, the money button. A great example for me is Facebook. They had 500 million mobile users, and one day they said, let's do advertisement, boom, $1 billion in revenue. Just, you know, in a year. So, you know, where is a company that had a new product and $1 billion revenue in the first year? So I think that a lot is actually invested in the future, and that may have some risk, as you know, when the stock markets fall and you're not doing profits, you know, and no one wants to invest. That's a risk of this growth strategy. But I think that the whole thing is about growth.
I fully agree, but inefficiencies are priced out of the market in this transparent world. I stayed at the Sheraton in New York City, great place, for $99 last week, because of the information that's available with some of these services. And so similarly, yes, Uber's great, but it's driving others out of business. And of course, part of that is part of the cycle. It's just at much faster pace than it's been in the past. And it does create opportunities, but for example, yeah, Uber might not be very good news for Detroit. I mean, it does shape industry.
But you know, in the Industrial Revolution in the 19th century, everyone was saying, oh, the Industrial Revolution would mean everyone will be out of jobs. But that wasn't the case. The jobs just changed. People had other jobs. You know, they searched for other jobs. And by the way, Uber has a target to get 1 million taxi drivers. By the way, I'm not from Uber. I'm not sorry. And also, you know, talk about Airbnb. Yeah. And so, by the way, if you look at the stock market, some companies are not valued so high. Let's take Apple, for instance. They have a PE ratio of 17. Is that high?
That's actually below the average.
That's very low, actually. And you know, and Apple and Google actually are as big as the entire DAX 30 together. All the biggest German companies have the same market cap like Apple and Google. So it's like, that's what we're talking about here.
It makes clear that in any technology transition, there's going to be new companies that are going to be spectacularly successful that then replace what people have done in other market segments. And for example, Amazon, you know, is clearly continues to raise and has increased revenue, whereas retail, traditional brick and mortar retail, has declined in some fashion year over year now. And it's just the overall effect on the economy is almost like neutral, right? One guy is rising, the other segment is falling. And obviously you don't want to be holding, I don't know, Sears stock or something like now when they're sort of on the verge of going out of business. But my, I don't know, my criticism with some of the venture investments has more to do with sort of speculation where there's absolutely no proof that it will work. And the most recent example is actually Bitcoin. So I don't understand what people see in Bitcoin, and they've spent $500 million venture capital big on startups, and it makes zero sense. Now I will spare this discussion for another time, but you know, I actually have to read about this because I'm going to have lunch tomorrow with some people who want to talk about this, and they somehow think you can revolutionize the entire financial industry with Bitcoin, which because it's a open ledger kind of thing. So I've now finally looked into this, and my conclusion is that you can split one Bitcoin into 100 million pieces, right? Is that the number? So if the Bitcoins are trading at, what is it, $300, each of these pieces is worth this infinitesimal fractional penny. So the value of the things they want to do with Bitcoin, like I said, ledger chain, is actually worth an infinitely small penny, because that's the true value of Bitcoin applied to whatever the idea is. And you just can't make money like this, you know? Whether you want to sell stocks or houses or whatever it is, you cannot make it up transactions to make it up. So even though Bitcoin is the lowest cost sort of transfer mechanism that may ever exist, it's not a way to actually make money. So I still don't get it why people invest in this, but it's just me.
Also, it's against everything that the financial world
Of course, it will get regulated anyway. So all the stuff that's really the favorite of drug dealers and so on is true, especially in San Francisco.
I want to say a word about going back to private company. You mentioned, looking at German opportunities because the valuations are so high here.
They're much lower in Germany.
I'm sure they are, and also in Israel, and also I think companies outside of Silicon Valley, maybe also out of New York, have a more modest way of burning cash and understanding what they are able to raise should take them along runway. And I hear, I'm sure you guys know better about the Berlin ecosystem that's growing in the startup world. I can tell you a little bit about the Israeli ecosystem, which is very good for startups. Just to give you some proportions, the amounts of VC money going into Israel is the highest per capita in the world. It's 2.5 times higher than the US. It's 30 times higher than any European country. The number of NASDAQ traded companies, technology coming out of Israel is the highest out of any foreign country. Actually higher than entire Europe put together. Actually higher than Europe plus Japan plus China plus Korea plus India put together. Much higher. So something is booming with startups and actually not growing, like you mentioned, like the biggest companies in the world. Yeah, no, but Israelis are known for building companies and selling them. We're a very small country. We don't know how to market to the masses. We don't know how to do marketing and sales for tens of millions. We're only 8 million people of a tenth of Germany. We're good at technology, and we're good at innovation. We're good at thinking out of the box, and where did this all come from? Probably a few factors, of course. A lot of immigration into Israel, educated immigration from Russia, from Europe. But most importantly, the military. I was talking about this with Oliver. That the military had such a strong effect on the high-tech. First of all, the billions of dollars that the Israeli government put into military intelligence, that nobody imagined that they'll have civilian use of created technology to listen to the enemy or to protect our computers or communication lines. And there came the first voicemail and first firewall and first flash disk drive and many other technologies that you use every day without even knowing where it came from. But more than that, the fact that each and every one in the population goes to military service, and at the age of 18, women for 2 years and men for 3 years, are suddenly held as an adult, accountable, responsible to make decisions, and you know, they end up being young adults that can lead a company, that can make decisions, that they can be accountable, be serious. Also, the Israeli military, for some reason, has the lowest ratio of amount of soldiers to captains. You know, each and every one of the soldiers is supposed to make his own decision. So you end up with a population that makes own decisions.
If I can generalize that a little bit without trying to encourage other countries in the world to increase the militaries to become successful, I think the strength that Israel has and Silicon Valley has is that there's an ecosystem, and maybe slightly different dynamics get us to that ecosystem. And one of the challenges Germany has had in the past, in the 90s in particular, and some of these things have been overcome, but is that in Germany it used to be that every single deal was structured differently. And when things blew up then in 2001, everybody was arguing with everything else. Whereas in the US and Silicon Valley in particular, these deals in some ways are cookie-cutter deals. You kind of know what you're getting into. And then of course you have all the resources, you have the lawyers, you have the money, you have the smart folks all in the same place. And it's just a lot easier for those leading centers to continue to lead. Of course, there are competing centers coming up. But when the next downturn comes, it's those newcomers, including Germany, I would think, that then is going to struggle again. Because again, they just are not at the same stage where Silicon Valley is. That doesn't mean you can rest when you're at the stage where Silicon Valley is. But I think it's the ecosystem that's really one of the reasons why Silicon Valley has over and over.
I wish what you said was true about Israel, but we're so innovative that we have to structure every deal differently, and everything.
So the middle term in Germany is that the ecosystem is still in the early stages and has not really taken off compared to what's present in Israel or in the US survey. And part of this is that there just aren't enough successful examples of companies that have enough exits for people to get excited about to make more investments in more companies. So this vicious wheel of recycling investment dollars just is not happening in Germany at that rate. And furthermore, most German companies don't focus on larger markets, in particular the US market early on. Whereas all the Israel companies are now, the first thing I do is open a sales office in Silicon Valley. And that's, I think, one key reason for their success. So German companies are well advised to send somebody over here early on and start selling in the US because it's such a much bigger, larger market than the German domestic market. And last but not least, in Germany, if you're a startup company, it's actually tough to get customers because they think you're going to go out of business, right? Because in the US, if you have a good product, they think you're going to be around and they buy your product, which of course helps your sales growth. And it's actually easier for a US startup company to sell into Germany than a German startup company selling in Germany, because the people have this attitude that German companies in the average don't pan out. And I'm just reflecting the reality there. So my advice consistently to German companies is to come over here and take advantage of access to venture capital and better valuations and just a much larger market.
Yeah, I couldn't agree more. I mean, we're running the accelerator now for 3 years, and it's always surprising but disappointing to see, that once they come here, they become interesting for the German market, right? So the deals we have made for them in Germany, where they have been trying to sell to a German company for months, right? They come over, we make the connection here, out of the sudden they're in Silicon Valley, oh, they are hot now, right? And now I'm buying as a German corporation.
It makes a difference.
Yeah, it makes a big difference.
Related to that, it's really interesting. I mean, I think there's another element that exists here, which is it's okay to fail. Nobody wants to fail, and we don't want to talk about it, but you can actually fail. And the key to failing is fail fast, before you raise all these millions of dollars and things get too complicated, right? And I think, when I interact with folks who started, in particular in Germany, failure is like, it's the end of the road. It's the end of life almost, right? Because I failed in that startup and I can never raise money again, and I might as well go back to a regular job. And so I think, that's sort of this forgiveness and tolerance, right? And the willingness to just power through it and say, there will be another day, right? And that, whether it's an investor or other employees that join, realize it's very risky. So there are a whole different tolerance for risk. I've just not seen outside. Even we are working with folks in Chicago, and even there it's very different from here. Things almost have to work out, and it's like, no, there's no guarantees.
But it's important to understand that the reason that the risk tolerance is high here for the employers is that they can always find another job, right? If one company A doesn't work, there's going to be company B or C that wants to hire them. In Germany, that's the labor market isn't that dynamic.
Right. In the state of California, non-compete agreements are illegal, and so that's a key ingredient too.
I think it's more of a cultural thing too. I mean, if you have tolerance to failure,
but it's understood that not everything works, right?
Yeah.
And as long as people put their best effort into it and really try hard, and when there's papers have been written about why companies fail, it usually comes down to not having the right product at the right time for the right market, right? But there's many variations of that. But the bottom line is, when people tried really hard to make something successful, they actually have become more desirable because they showed their commitment to build something, and people do learn the lessons. So there's the experience factor.
Mm-hmm. I'm sure we have some in this room who say, oh, I'm working my third or fourth startup. And in Germany, you'd say, I failed in 3 businesses, right? And here, we admire them that you keep investing and innovating.
Yeah, it's also a bit about, I think, the question about the sales culture here. My daughters went to the Swiss school in Zurich, and since they're here, they kind of know how to sell better. they come home and they get more out of me basically. And if you think about that, the German word for selling is verkaufen, and verkaufen has a kind of a negative connotation in a certain sense. If you sell, if I say you sold me something, du hast mir was verkauft, it sounds like you yes.
You twisted your arm.
I twisted your arm, or just it was yeah. So, but here, the Americans say you sold me, and that means you did a great job.
So you might want to add for those that don't know Switzerland, if you can sell a product in Switzerland.
Yeah, because you can only lose in Switzerland. That's the thing, and I think selling is. Actually, there is a small thing that I've noticed very much. When you sell in Germany, a merchant, for instance, in our case, our usual sales pitch is, yeah, we do this and this, and then the German reaction, the first one is, no, doesn't work. Right? And actually, the trick is insist, saying no, it works because of A, B, C, D, E, F, and I can explain you from a technical point of view. And then if you insist enough, then he signs up. He installs the whole thing, he pays your bills, he does everything, he's a great customer. Yeah. When you come to the US, the first reaction is, that's amazing. As a German sales guy, you would say, I got my client, I got my revenue, and I got my sales commission. And then you call a week later and say, so, you remember, amazing company? Yeah? No. So you have to explain them again who you are, what you're selling, right? Yeah. And then, and the thing is, you have to insist as well. Like in Germany, it's actually similar. If you don't insist, if you're not persistent, you don't succeed. That's unfortunately the way it works. And then you insist, and then they register and say, so, in our case, so where's the product? And then you have to explain, no, you have to do certain things to make it work. And they say, oh, no, I don't want to do that in the US. I pay you $10,000, do it for me. Right? While the Germans would try to do that themselves because they want to save the $10,000. That's kind of things that I think you don't get in Germany when you're just there. And you talk to an American and you think you're going to conquer the market in no time because everyone says you're amazing. That's very not true. And something to.
And on that note, by the way, I don't know how many of you are aware that a company like Walmart is not succeeding in Germany. Part of it is that you have the Mittelstand in Germany where you just don't have as many layers of management. You do everything yourself and you're counting every penny. So the margins are much tighter there. Here we don't mind paying for layers of management, or in the VC case, putting all the money into getting to market quickly.
If I may add another interesting thing that I've noticed since I'm here. So when I went to Walmart, I was overwhelmed about the number of orange juices. Because in Germany, well, first of all, Europeans always buy the same orange juice. No, it's like not, you don't buy every time another orange juice, but just have your orange juice now. And you know, Walmart is like, you know, organic, non-organic, with food, with you know, like you're very confused, and so competition is much higher. That's something that I've derived. And actually, what I noticed in our sales is you even have competitors where there is no competition. What I mean by that is that Americans, it's a very generalized thing, so I'm a bit doubting about that, but I think that many people sell things they don't have yet. So they first sell it like short, you know, they short the sale. So they sell your product, and when you say yes, I want to have it, then they desperately look for how to get this product and give it to you. You know, when in Germany you first have the product, then you sell it, and that's, you know, that's a very interesting thing, because then suddenly you have lots of competitors that are not really competitor yet, but may become if they see an opportunity.
So I have many more questions, but I want to open it up at this point. Hopefully some of you will ask the same questions. So,
the panel touched on the U.S. equity market outperforming many other major markets from a variety of angles. The world is a very dangerous place, it always has been, but in the current environment, we have Russia invading neighbors, China confronting, menacing Japan, Philippines, Vietnam, India, Iran on the brink of nuclear weapons, the Islamic State in the Middle East. How much does the world being a dangerous place and the U.S. being a safe haven of sorts factor in and to U.S. equity market valuations? And if the world becomes a more obviously dangerous place over the next couple of years, what would the panel expect to happen to U.S. equity markets versus the rest of the world?
So in my opinion, you know, it is factored in, but actually it's a positive effect because it doesn't really matter what's happening in Ukraine or even other places you mentioned to the U.S. The U.S. doesn't export much of anything to the Ukraine or to Russia to this point, so they actually kind of isolated from that. Whereas in Germany, you're very much worried about this, right? Because you may not get your gas next winter or whatever. So there's very different reactions in the U.S., which is a very large homogeneous market, compared to smaller countries that are much more exposed to these effects, whatever they may be.
And I agree with that. Let me just add to that. The markets have been rising on good news. They have been rising on bad news.
It's unbelievable.
But just the same, markets can be falling on good news, and they could be falling on bad news. So there's no assurance that this is going to continue one way or another. And as I indicated, the key success has been the printing presses of the world. And that can also work in reverse. And all else equal, that has to mean that asset prices are lower. And by the way, one thing I just want to add to what he said early on, he said interest rates will have to go higher. Well, real interest rates, not necessarily. Real interest rates are interest rates when you deduct inflation. Many people may not be aware that on a real basis, interest rates in the US are much lower than in the Eurozone. In a year from now, I'm almost certain that real interest rates will continue to be much lower in the US than in the Eurozone. So many of these things, and I think you somehow implied that I thought VC was safe or something. I'm actually at the other end of the spectrum. I don't think anything is safe in the world anymore. You used to be able to have cash to be on the safe side of things. Well, what is the euro safe? Is a dollar safe with the sort of debt levels and entitlement issues that we have? And so, again, the sophisticated investor will be just fine. You can invest in a world that's risky. But then, a crisis, when a crisis pops up somewhere, usually markets sell off. Well, but markets get used to crises. And so you know how to deal with the threat of this or that. In the beginning, it's a threat. So Germany got all spooked with Ukraine and sanctions against Russia. Again, eventually, you learn how to deal with it and realize the life goes on. But none of this assures that market's going to go up or down. And then just the point on the U.S. being the safe haven. After 2008, that doctrine was really put into everybody's mind that in a risky environment, the U.S. is the place to go. I would argue there is absolutely no assurance that's always going to be the case. And this morning was a case in point that the stock market sold off and the dollar sold off quite sharply and the euro rose quite sharply. And the thing is, what happens, these correlations are morphing. And take the summer of 2012. And Draghi came out and said he'll do whatever it takes. Well, at that stage, we came up with a call that said Draghi is a genius and everybody should buy the euro. We got lots of feedback, none of which was positive. And basically, what happened at the time is the euro was cheap, probably for all the right reasons, and it was less risky than it was before because Draghi had put in place some protection. And so suddenly, when risk was on, when people wanted to invest in risky assets, they bought the euro, they bought Portuguese debt. A year and a half ago, when the taper talk flared up and money fled emerging markets, it didn't make it to Silicon Valley to VC, it made it into Irish